Our typical client is a privately held business owner, and they've really never been through a formal valuation process before. And they're really uncertain as to what is expected of them and the process itself, and they really look to the UHY advisor to help them understand all of the things that will be asked of them, to kind of take them through the process from start to finish with a lot of instruction along the way. The business valuation process starts out with an engagement letter, okay? And that engagement letter gives specific details to the appraiser as to what they're valuing. For instance, are they valuing a controlling interest or a minority interest in the business? What is the valuation date that the appraiser is to derive value from? It will describe what the standard of value is that should be used. For example, fair market value is the most common standard, which means that there's a hypothetical willing buyer, willing seller that the appraiser assumes in the process, or there could be a strategic value. And in that scenario, you're looking at a specific buyer, looking at the company for its specific reasons. And there may be some differences in how the business is valued given those types of components. So that's really step one. Once the details have been established in the engagement scope, the appraiser is going to want to dig into the assignment and start to learn more about the company itself, the history of its operations, the geographic locations, the types of products and services that the company is providing out there in the world. Just acclimate to the business itself. It's very important for that appraiser to have those qualitative aspects to the business kind of in mind as they're going through the appraisal process. So once we've got our arms around the economic environment, we tend to turn our focus towards the historical operating performance of the business. And we're typically going to look at the last 5 years' financial results, and we're also going to be looking forward if the company happens to do detailed projections, because we're obviously interested in the trends we see in the business. Is it growing? Is it stable? Is it declining? When it comes to appraisal approaches, there's 3 traditional approaches, which is the income approach, obviously looking at the performance of the business itself from a profit and loss standpoint. There's the asset approach, which looks at the tangible value of the business itself. It's fixed assets, it's real estate, it's equipment, maybe it's intellectual property, those types of things can be captured that way. And also a market approach, which is to say other businesses like this business, what have they sold for in the past, and how can we infer various valuation multiples from that and apply them against the subject business. After we've looked at the 3 approaches to value, we'll come back full circle back to the engagement letter, and where we talked a little bit about whether or not this is a controlling interest or a minority interest in the business, because it might be appropriate for us to consider discounts or premiums. Discounts being for things like a discount for lack of control, i.e. the inability to liquidate the assets of the business or to cause a transaction to take place. And so empirically we can look at the data for these discounts and apply them to the subject interest in concluding on the equity value of the business, the per share value of the business. Once we've done that, the appraiser then needs to compile all that they've learned about the business in all of these areas that we've talked about, and they do that in the report because we're trying to document, as of the valuation date, all of the different things that the appraiser thought about in arriving at its conclusion. That gives the report the ability to have someone else who's not knowledgeable about appraisals to review the report and draw the same conclusion that the appraiser did. They may not agree with it, but they'll at least be able to recreate the appraiser's thought process within the reporting. While every business valuation has unique aspects to it, there are certain fundamental documents that can be gathered to help the appraiser get underway in an efficient manner. We're always going to be looking for the last 5 years' financial statements, tax returns, trial balances, and if the company happens to prepare projections, we're also interested in those particular details to give us a good financial footing. We're looking for things like the fixed asset lapse in detail, which will allow us to understand the types of assets that the business owns, how old they are, etc. We're looking for various legal documents shareholder agreements, buy-sell agreements, operating agreements, things like that that have provisions that address how shares can be bought and sold within the business, the life of the business, etc. So any collection of legal documents pertaining to the operations of the business are useful to the appraiser. We are interested in how the company perceives its competitors in the local and global economies. We're interested in understanding the industry associations that the company may belong to, because often they'll put out annual ratios or benchmarking type surveys that will allow the appraiser to acclimate quickly to the latest trends within the industry. We're also interested in any past transactions that have taken place within the business. That gives us evidence of transactions within that specific business that we might be able to leverage a valuation ratio off of if we deemed it to be arm's length transactions. We're interested in gathering historical real estate and equipment appraisals to assist us in the asset approach. We're interested in gathering top 10 customer information, and that may be broken down by service or product line, just helping us to understand how the business makes money and which elements are profitable and which are not profitable, if that may be the case. We'll be interested in items such as the organizational chart, just to understand the depth of management, which may have impact in relation to different business risks that are present in the business. We're going to be really interested in understanding in that 5-year historical financial window that we talked about, items that are discretionary in nature, i.e. excessive compensation levels, things like that, non-recurring and non-operational events, so insurance payouts, things of that nature that are not part of normal business operations. We're going to use that information to help us normalize the income stream. Gathering these basic documents will really help the appraiser to be efficient in the appraisal process itself. There will be unique document requests based on the specific industry, but if the owner can keep these basic items in mind, it will really help speed the process along.